Topic 1. Energy and geopolitics are driving prices and market volatility. Summary: geopolitical tensions centered on Iran and the Strait of Hormuz have driven Brent crude up to about $141 per barrel, triggering broad market volatility and higher travel costs. Jet fuel prices have spiked globally, pushing up both private jet charter rates and commercial carriers' ancillary fees, with airlines warning of sizable losses if high oil persists. News about Iran-Oman talks or other calming signals temporarily ease pressure, but the overall risk to supply routes and markets remains acute. Details. Cause summary: the Iran-Middle East war and related tensions around the Strait of Hormuz, combined with hardline U.S.-Iran rhetoric, have pushed international oil prices sharply higher, Brent near $141 per barrel, and that spike has amplified airline and passenger costs and market volatility. Aviation and fuel impacts, private and commercial. Jet fuel has surged, global averages near $4.65 per gallon, U.S. metro areas roughly $4.5 to $4.9 per gallon, with some indicators showing more than an 80% rise month over month. Private jets. Higher fuel costs have caused charter rates and surcharges to rise. Examples cited: Dubai-London charter rose from $400 in 2023 to $520 this year. A broker attributed the increase entirely to fuel. Average charter fees rose about 5 to 15%, with some up to 20%. Commercial airlines. Elevated fuel costs increase carriers' expense burdens, prompting hikes in ancillary fees such as baggage charges. Example: United's first checked bag prepay $45, same day $50, and airlines warn that prolonged high prices could produce losses and operational strain. United's CEO warned of multi-billion-dollar losses if current fuel levels persist. Market and financial effects. The oil spike is widening volatility across stocks, bonds, and FX markets. Asian and European stocks weaker, the dollar strengthening as a safe haven, and benchmark yields rising. Oil moves are reactive to Strait of Hormuz developments. Talks between Iran and Oman on corridor protocols have offered brief relief and trimmed some upside in oil. Airline industry responses and risks. Some operators pursue fuel hedges, refueling in lower-cost countries or recommending smaller aircraft to reduce costs. Long-haul routes may incur higher fuel consumption and costs due to deviations and rerouting. The shock is seen as largely short-term for many, but sustained pressure could lead to bankruptcies or restructurings across the sector. Core conclusion: geopolitical instability tied to Iran and the Hormuz corridor has driven a sharp rise in oil and jet fuel costs, producing cascading effects, higher private jet and airline charges, and broader market volatility, with only episodic relief from diplomatic signals such as the Oman talks. Topic 2. A presidential directive ordering 100% tariffs on drug makers that won't cut prices signals aggressive government intervention. Summary: the president ordered 100% tariffs on imported medicines from drug makers that refuse to agree to retail price cuts, using tariffs as a direct lever to force lower prescription prices. The move aims to sharply reduce consumer drug costs and incentivize domestic production, but it risks harming pharma profits, R&D investment, and international trade relations. Implementation, supply chain disruption, legal challenges, and possible adverse effects on patient access make the policy highly contentious and uncertain in practice. Details. Action described: the president directed foreign drug makers that do not agree to price reductions be hit with 100% tariffs on medicines they import, an explicit use of tariffs as a coercive tool to compel prescription price cuts. Policy intent: the measure seeks to dramatically lower retail prescription prices and to promote domestic manufacturing as part of a large-scale, interventionist trade and industrial strategy. Effects on pharma profits: some companies may lower prices to avoid tariffs, but those too